Sometimes people with a clinical background don't get their fair due because they weren't a banker, they weren't an analyst, they don't have a CFA. If you're in healthcare and you're a JD, you're an MD, you're a pharmacist, you have special sauce.
This is Second Opinion. I'm Christina Farr.
I'm Ash Sanews. And I'm Luba Greenwood.
Welcome to the pod, where each week we navigate what's really going on in healthcare through strikingly candid conversations with the entrepreneurs and investors leading the charge. As your co-hosts, we promise to bring the perspective of a former journalist and investor, a doctor, a lawyer, immersed in the future of medicine with life sciences and digital health.
And we're here to sift the signal from the noise in all of these conversations. Thanks for joining us. Let's dive in. Make sure you stick around at the end of the interview for our debrief.
Excellent. Well, we are so excited today that my dear friend Meg FitzGerald is joining us. As you all know from reading Second Opinion, she was one of the first people that I had to profile because she is both a nurse and a private equity investor. She sits on a ton of boards, including Tenet. So she's really seen healthcare from all sides. Meg, in this market that we're in now, why are we not seeing PE jump in and be way more active? Shouldn't there be a total frenzy given that everything is down?
Great question. First of all, nice to see you. Big fan of the show. Nice to see Ash and Luba and the whole group here. I think, first of all, the long-term outlook for private equity, I think, is incredibly sound. But the last 24 months have really rocked the industry, mostly because of what you all cover here: spiking interest rates, deal making's down, exits are down. There's really I read $3 trillion in backlog. And what does $3 trillion in backlog look like? That's 28,000 companies that could potentially be for sale right now. That's kind of a mind-blowing number. And the average, I think, hold period right now out of those 28,000 assets, 40% of them have been in the hold period for 4 years. So to your point, there's a lot that should be for sale, but with spiking interest rates and people trying to get funding, pulling off $1 billion deal, which really is, a big difference between private equity and venture capital, is you need the capital and the debt to finance those deals. So it becomes very difficult, I think, for people to get financing. But two, the assets are really valuable to the owners and holders and CEOs. So they also don't want to sell them at a discount. So I think you kind of have this chicken and egg where if interest rates would be a little more favorable, I think a lot of those assets would probably trade and people would be a little bit more aggressive. I also think the yield curve being inverted, people not really understanding why the market continues to do so well, has made, I think, people a lot more discerning and disciplined. You have to have a real strategy if you're going to lean in and acquire something.
So that's fantastic, Megan. Would you be able to give a little bit of background of, especially when we go to digital health, health tech, what is the difference between venture capital and private equity?
I get this asked every week, especially when I teach up at school. All the students always say to me, I think I want to be in venture capital. I think I want to be in private equity. For me in healthcare, I think they've started to merge. And you have this new field where it's growth capital. People want to get behind a great idea. They want to grow something. Traditionally, someone would say, hey, I don't do a deal in private equity if the underlying EBITDA is not higher than $40 million because I'm buying something off a multiple. Where people, I think, in more venture capital could buy something that doesn't have any EBITDA. They could buy even ARR, which has been a problem, not just revenue. So I think traditionally it's been the size of the check, stage of the company. However, I've noticed in the last 2 years, a lot of this in healthcare is merged, where people in private equity are starting to do growth and people that are in traditional VC are starting to flex up and write bigger checks. And I think they're competing for some of the same deals, or they're seeing them within the same cycle, which I think is super exciting. So I consider myself an investor. I do seed, I do venture, I do private equity. The one thing that I don't leave is the $4 trillion of healthcare. So I think for me, I'm a little biased that I think the capital should fit the strategy in healthcare and less about, oh, your venture, you can't lean into this deal, or your private equity, you can't do that. I think it's down to the capital and also what is your underwrite strategy? What is your return profile? What are you solving for with the money that you're managing and what do your LPs want?
I wanted to ask about growth because you just mentioned it. Growth is an area that when I was in venture, we would often talk about the growth guys as being much more fortunate than us because they just had proof points that the people in venture didn't have, and it was much closer to an IPO in theory. But I'm reading now that growth just seems to be the most squeezed and hardest hit of the areas that you just mentioned between venture and private equity, because the IPO window is just not open, and a lot of these businesses just can't raise the capital that they need to raise. So I've heard some theories that maybe growth goes away, maybe venture kind of starts going later stage, private equity goes earlier. What do you think is the future of this kind of growth stage?
I think it really comes down to this idea of delivering revenue versus selling ARR. So if you're selling ARR and it doesn't turn into revenue soon, then I think you've got a problem. No matter what company you are, what stage you are, what sector you are. For too long, people were selling off these ridiculous valuations on ARR that didn't pan out, might not pan out. And I think people have kind of realized they want to see proof of growth, no matter where you are, whether you're venture or private equity. And for me, I look at team, differentiated value prop, and like real line of sight into revenue. I don't really lean in on things that have promised ARR unless I know it's a client that's going to be upsizing, a piece of business for a company that I'm investing in. So for me, I think a lot of people got burned at higher valuations on promised ARR that didn't materialize. Personal view.
I think it's a very strongly supported by facts personal view. So I couldn't agree more. It is something that I have been just watching in shock and awe. And one of the reasons I switched to predominantly doing mostly biotech and diagnostic and medtech over the last 2-3 years is because you had way too many digital health tech deals that were promising to cure, well, not cure everybody, to increase outcomes. Nobody even talks about value-based care anymore because people don't want to listen to it. They want to see, okay, have you sold anything? Have you delivered on the promise that you've been saying you're gonna have acquisition of this many customers, or you're gonna have this many deals, or you're going to sell your software for X amount and to 10, 15 companies, and then it will scale to 100 or 200. So I'm glad that this is what you're seeing, and right now there's definitely a correction in the market. And a question here is, do you think that realistically speaking, if you're not delivering revenue, and I have been on the acquisition on the buyer side for many years at big pharma and tech, we would never acquire anything with a promise. We like to talk to those people. They're always fun, and they're fun to invite to our conferences, and they're great to hang out with. But we won't buy them because they just don't have any revenues. We always want to see at least initial 18 months of revenues and a promise of pretty exponential, fast, realistic growth, and hopefully not the one where you're talking that you're going to go to other countries type of growth, but actually a growth that makes sense state by state or customer by customer. Do you think now that there is a correction, do you think there'll also be just shrinkage of the amount of capital that's available for these deals? Because realistically, there are just not that many companies that can deliver.
Yeah, it's such a great question. And as I'm listening to myself, I'm like, all right, I hope I don't sound, all 1997, because I feel that we need to lean into digital and all this innovation, because you can't do billing very well as a patient. You don't have line of sight into what goes on with your x-rays. Really mundane, boring stuff in healthcare is like, you show up for surgery that's at 8 for some people and they get seen at 5. Imagine if there had been an AI queue to say, okay, anesthesia's ready, it's a go, surgeon's ready, OR team's ready, show up at 3. You didn't need to show up at 8. So when we say no one wants to invest in digital and people have pulled back, that to me, and Chrissy wrote a lot on that, that's a travesty, and I think it's a danger, because that is the group that is going to do the hard work to fix some of these mundane friction points that we need to be addressed. So what I say to those people is don't stop. I invested in Hummingbird Health. That's a team that was backed, a founder that worked at Epic, literally, is working every day to close pieces of business. And I came in when they had, the system of Colorado on the line. They had like real revenue and a real partner. And that to me was the green shoots that gave me confidence that not only were they solving a business problem that was super important in the hospital system, they had an all-class, all-star team that had pattern recognition, had done this before, and then they're delivering on a good partner and a piece of business. So for me, that's like how I got comfortable. But I think you're right. A lot of people have been burned. They spent a lot of money. Nothing materialized. So if you're sitting on a fund that had, 5 failures in a row, you're going to pull back and you're going to want to invest in something that actually has proof of principle. And there's some other areas of healthcare that I think would give you more confidence to do that. Otherwise, you're not going to raise a second fund, right? So I think we just need to be realistic that there was a lot of air and PowerPoint and AI sprinkled into a lot of business plans over the last few years. And quite frankly, you could have thrown a dart at the wall and done well in your S&P portfolio just to put money into the S&P. So I think like you got to be a little bit smarter now as an investor to chase some of these ideas, or like I said, have real conviction around this. And I'm happy to share a dinner I had last night with 2 healthcare system executives on why they are not or sometimes leaning into digital health. So a bit of a cliffhanger, but happy to go there too. Just want to listen to your questions.
Meg, I'd like to change gear from digital health for just a quick second here.
Yeah.
Private equity has gotten heavily involved in rolling up providers. And we hear a lot about this. Is it better? Is it worse? They started with urgent care, primary care, and now it seems to be expanding to every specialty you can think of. Well, how do you think the strategy is working out for the private equity investors? Has it stalled? Is it growing? How do you think it's working out from your perspective for these provider organizations, small and large? And then we can talk about patients.
Yeah, well, for me, at my heart, I'm a public health professor. I have a PhD in the sociodeterminants of health, and I volunteered in the ICU during the pandemic. So I'm a public health capitalist. So first and foremost, if you're buying an asset, you have to deliver on clinical care and make something better for a patient. If that's not what you're doing, then you will be discovered and this won't work out and you're going to hurt the whole industry. So first and foremost, if you're owning physicians to not make care better, if you're trying to own something to make a profit off a patient, I think the market is starting to take care of that and be upset about it. However, I will tell you right now, not many people are looking to do urgent care in rural settings. And we have 100 million people that live in a care desert that need a pharmacy, need an urgent care, need a nurse practitioner, need a physician. So I was part of a deal last week that leaned in to acquire an asset that's doing rural healthcare, right side of the angels, right side of profit, doing well by doing good. I have no problem with private equity doing that. In fact, if private equity or a growth firm didn't lean in on that, I don't know that anybody would have wanted to scale that business to give care to 100 million people. So for me, I think you do the right thing with the patient, with the quality, the capital follows, and everything works out fine. If you're doing something else, then I think a few people have been caught out. And I don't really have a comment on that other than that's not what I do. And a lot of people that I follow in the majority of the industry, that's not what they're doing. That's not what they want to do. That's not my crew. That's not who I'm hanging out with.
So one of the things I was going to ask you is because you are very unique, although you tell me whether or not that is the case. Are you a very unique person, a very special person to do private equity? And perhaps that is the reason, because of your training in healthcare and your understanding, both in healthcare and as a nurse, so both as a provider and understanding overall healthcare delivery, you have a unique angle, not only understanding the true need, but also, as you said, you look at the team. And so you have a unique perspective and understanding of what team can truly deliver and understand the value that they can bring to patients and which cannot. And so, Mike, well, first of all, I would love for you to also just introduce yourself with your background because it is so different. And the second question is when you teach, and I'm sure so many young people come to you and they say, hey, I want to do private equity, or I want to do venture, or I just generally, or I want to do what you do, because again, as you said, it's sometimes hard for especially people that are entering the market, to understand, what is growth capital? What's the difference? What's the difference in the terms? Can you also talk about what do you think is that profile of a private equity, especially in health tech and digital health space, that you think will, first of all, pick the right winners and help build the right companies?
Yeah, I love this question because I think sometimes people with a clinical background don't get their fair due because they weren't a banker, they weren't an analyst, they don't have a CFA. And by the way, my husband has all that. He's an economist, and he said to me in the very beginning, capital's the commodity, Meg. It's the content and connection. So if you're in healthcare and you're a JD, you're an MD, you're a pharmacist, you have special sauce. You have pattern recognition. You have real life frontline experience. You understand we're the most regulated industry, right up there with an oil and tech company. You understand how to navigate Medicare. By the way, the government is half the payer in our $4 trillion industry. So for me, you're inherently advantaged by being a frontline person. You understand what works. I remember someone telling me about AI, and there was a robot behind me in the ICU delivering supplies. And I'm kind of chuckling during the presentation because this AI was going to transform the hospital. But in reality, in a middle market hospital, the AI robot that they could afford was delivering stuff, and it was banging into walls as it was delivering stuff. So it was kind of like a splash of cold water because of those of us that are on the front line in a pharmacy, venting people, running codes. You kind of know what works and what you need. So I lean in on people that have a healthcare background. And by the way, I heard a rumor that there's a bunch of clinicians and frontline people getting together and maybe starting a fund. I don't know. Maybe Chrissy can break some news on that in the future. I don't want to be the one to do it, but I was all in. I might have been one of the first checks in. You'll have to check the diligence on that. But I was like, this is a group of advantaged owners. However, with that said, what I've learned spending, 7 years now in private equity, underwriting and doing valuation work is the most difficult thing I've ever done or I've ever been a part of. Full stop. Putting a value on a company is not for the faint of heart. You need the skills, you need the pattern recognition. I've learned so much from the people in private equity and have been super impressed. And again, I was in the Fortune 500 for a long time. Pfizer, Merck, Cardinal Health, worked with some of the best companies in the world. Those that do underwriting in private equity, the process, the discipline, the risk, having it all on the line to make a bet on someone else's money is extraordinarily difficult. So the unicorn for me is the person that can do both, or the teams that put an Ash and somebody that has that pattern recognition, has done valuation for 10 years together. It's not an either or. And I think for a long time, the industry put more of a premium on the valuation work. And then you'd find out that most strategy doesn't survive first contact. That the second it goes out to a hospital, the hospital's like, I'm really sorry, I'm doing an Epic install. I have absolutely no time to look at your super cool solve for billing. I know it's right. I want to do it, but I don't have time to do that right now. It would have been the healthcare person that would say, hey, listen, right now they're going through an Epic install. That's actually not going to work. If you sold something that was directed at patient safety, you would have had a better time. So anyways, long story short, very bullish and think there's a huge opportunity for those of us that know healthcare really well and want to invest and be entrepreneurial. I think that's a totally differentiated model, and I'd bet it'd be very successful with outside returns. I'm going to weigh in hard to say that.
Hey everyone, we'll get right back to the conversation after a word from our sponsors. Is your healthcare org a tangled mess of Christmas lights? Your care teams are drowning in manual work, juggling dozens of point solutions and burning out in Excel hell, while your engineers work through a backlog bigger than a surgeon's ego. Awell is here to untangle the mess. Their care ops orchestration platform lets ops and clinical teams design, implement, and improve care flows in days, integrated seamlessly with your tech stack. The result? Automated processes, fewer soul-sucking tasks, and faster care model improvements. This year alone, Awell has orchestrated over 14 million care activities for leading organizations like Astrana Health, Commons Clinic, and Better Health. Ready to save your team from Excel hell? Visit awellhealth.com. That's AWELL health.com. And mention this podcast for a free bootcamp. They'll take you from zero to an implementable workflow in 2 days or less. Awell, make your care flows work harder than your care teams.
Meg, that's really interesting. How do you recommend people in healthcare that haven't worked with private equity or VC or any other type of investor actually get involved? Is it getting on boards? Is it joining to help with diligence? Like, what is the process that you recommend? You seem to have gone through the journey yourself, and so I'd be curious to hear on that from you.
Well, I worked for free for a year as an intern, an informal intern. I called a few people I knew in private equity that were really smart, and I said, could I have exposure to the field? Ideally, I'd love to join a board. I don't want to work for free, but I've been told that I wasn't a banker. I'm not a CFA, sometimes worse, that I was like a clinical person. So how could I put money to work? Even though like I ran M&A at Cardinal, I did an M&A job at Medco, I did strategy at Pfizer. Suddenly like that didn't matter. That was crazy to me, by the way, but it didn't matter. So fine, I got to find my way. You see a closed door, find an open window. So I said, could I have exposure? So I was invited to LP meetings, board meetings. I got to work for free on a deal. And I knew that I'd make myself indispensable, especially if it was a healthcare deal. I was like, I'm going to rise to the occasion, do what I can. Two other things I did was I called two banking institutions I know. And I'm happy to give these groups names, by the way. The private equity firm was Towerbrook. They're amazing to do that for me. And Lazard Banking. They set up a debt class for me where I went downtown and we did debt 101 because I thought in private equity, you needed to know a lot about debt. So I went to debt school and put these modules together and was self-taught. So by the time I got done with this, I remember sitting in one board meeting and it was a public company. I'm like, wow, our debt levels a lot. Like we need to get that down like by 3 turns by next year. What could we do? And I remember people thinking, wow, the nurse is talking about debt levels in the board meeting. And I really owe it to Lazard for like letting me know when to ask that question and when to make it real in my job. So my advice to people is ask somebody, don't ask them for a job. Whenever you ask someone for a job, unless it's like one of us, it seems like people get turned off to that. But when you say, tell me about your journey, can I join a meeting? Can I get exposure to your field? Inevitably, when you make yourself invaluable, they'll lean in. Ironically, I'm now an advisor to Towerbrook. It took a while. And it's like one of my favorite firms. And I love what they do. They're willing to, hunt in the basement of a hospital, put really great deals together, do the hard work. But I was willing to like put myself out there and say, could I bring some value knowing that they didn't want to pay me? So I think you've got to be willing to reinvent yourself, be a student of the craft, and also realize where your personal alpha is. Where do you bring an advantage? And again, if somebody is a private equity or venture firm that hunts in healthcare, I think they're a very bad investor if they don't want to talk to the people that are in healthcare, especially if they're willing to hang around the hoop for free and be part of their deal. And then you make yourself indispensable, and the rest is history. And a board is a great thing, Ash. I'm also told you can't be on a board till you're on a board. That was like you couldn't work in marketing, you worked in sales. It's always these little games and little hoops you got to go through.
Yeah, I mean, I think you're right. And we tend to put people in boxes, which is something you and I have talked about, that you have to be clinical or you have to be financial or you have to be in communications and media. And some people are just all of the above, and that's okay. Like you and like all of us. So I think just returning back to digital health, because you kind of left us with a cliffhanger there. I wanted to put everybody on the spot, all of us, Luba, Ash, Meg, and just hear in a word, as you look at digital health right now and what's happening in the market, are you bullish or are you bearish? I'm gonna kick it off with Luba, then we'll go to Meg, then Ash, and then I'll kind of leave my opinion.
Okay. Actually, how about Meg? Meg, you go first. I'm curious what you have to say.
Okay, so if you're giving me a binary question, I'm a bull, but obviously have investor caveats. I think it's needed. So I'm a bull for the field, a little bit bearish on the investment case. Is that okay? That's not a cop out.
That's fair.
That's an answer.
We'll take it.
Okay.
I love it. I agree with you as well. I think on the investment side, it also depends on in what area. Right now, I would probably focus on growth deals and probably growth just a little bit before even traditional private equity. That's probably where and Ash is really an expert in this space, is where do you find the type of a team and also the type of a value proposition, but also really digging in, to your point, Meg, on the finance side and actually really digging in. how they're reaching out to the customer, what's their likelihood to get that next account, depending, of course, on the type of product or service that you're providing. So I would probably say I would be a bit more bullish on the later stage, more growth stage digital health companies. On the earlier stage, I think you just have to be careful. You have to identify one need. Don't go grand. I think going grand and with promises is not the way to do right now. And probably that window of opportunity to make grandiose statements and drive value that way up with promises of ARR probably are gone for at least a few years. So focus on one thing that you do really well, baby steps, and execute. And then perhaps there would be some money for early stage opportunities.
I'd have to agree. I think I'm a bull for all the incumbents that are in the market today. I think it's much easier for them to scale and get in and grow digital health. But I would say I'm probably more bearish on early stage companies that don't have product market fit, that are going into point solutions that I haven't really thought about integration, right? So if you're still thinking about those questions and you're coming to market without having answers, I'd probably worry a little bit, get your act together before you come to the market, because I think you'll have issues scaling and getting investments.
By the way, I think what we're all describing is we're bullish on the need for this and that this should be done. We're bearish on where to put the money, and that's because our industry is not stepping up. So there's bulls and bears, and then there's some chickens. So some people have to lean in to give a home and give time to get this off the ground. And so I think that's where there's a hesitancy, is our industry sometimes is 10, 20 years behind some others. And so you have this great technology, but it's a hamburger looking for a bun, and it's not fair. And we've got to do better about that. And I think we've got to help these companies and CEOs find real landing, not pilots, but real use cases so they can get in and bring value right away. If you don't bring value to a system within a few quarters, they unfortunately don't have the operating model and margin profile to wait 2 years for something to work. They've got cyber events. They're onboarding Cerner. They're going through meaningful use. They're trying to do post-acute. It's unreasonable to expect that they could wait around on 100 pilots to show value and help their patients. So I think there is a bit of a disconnect, that it's not the market, it's not the companies. Remember that, hate the game, not the player. In this case, you've got to understand the game and the field, and healthcare is really slow and extraordinarily complicated for a lot of reasons that a lot of us like and haven't changed. So just as a side comment about it.
You know what? That's so interesting, Meg. I would say maybe even for new companies that are thinking about coming to market, maybe save some space on your cap table for your health systems or your pharma companies or wherever your market is, so that they can be a partner in this growth with you. That's probably a better long-term strategy.
Yeah, and I was told sometimes a system says, hey, I'm putting you in 20 systems. I'd like to be an investor. I'd like to realize some of that value. You may have to be creative that they are helping you prove principle and prove revenue. And so you might have to get creative about your own cap table. Chrissy, bull, bear.
So I'm going to go bear on digital health and bull on health tech. I think a lot of areas that we would associate with digital health have point blank not worked. I mean, digital therapeutics has been a complete disaster. I think a lot of aspects of things like RCM and CCM have not worked or found their business model. So I can't see a case for digital health, and I actually would love to retire the term at some point. Health tech, though, to me speaks to just how much the healthcare industry needs technology. And when you peel it back, all the way back, I think you can start to get into some really interesting biotech, like some of the work that Luba's doing. You can start to get into some interesting health system modernization efforts like Meg and Ash have been involved with. So that's why I prefer that. I don't know how everyone else feels, but I'm about ready to get rid of digital health.
Maybe this is the day.
Yeah, this is it.
This
we'll
is
do
it
on this podcast. That's it.
Done.
Chrissy, we're no more digital health. Health tech it is.
I will not mention it again.
And I agree. And it actually goes also to the types of investors. We talked about really investors that are in the industry, either healthcare generally or biotech or tech. Some people do rely on generalists. And by the way, generalists are coming back. Meg, you're probably seeing some. There's a little bit more appetite, but we should be careful. I would probably urge many companies not to take advantage of that too much and just go to generalists, but really match that up with checks from experts that can help you with that scale that you will need. Because if not, then we'll go back to the hype where we came from. Many of our audience, our listeners are, I would say, mid-seasoned, mid-career, late career individuals. And many do come from those places, as you, Meg, have called. I love it. I'm going to use that term as somebody that can recognize pattern recognition, and also comes from the regulatory and the healthcare side, such as lawyers, such as physicians, such as nurses and providers, other providers. I think that it's wonderful and uplifting to hear from you that you don't have to start from the banking. And actually, there is an advantage, especially now that we're going more into health tech, further away from digital health, and starting to tie it truly to the need, be it for the patient need, what the hospital, the providers need. Or in the biotech, and augmenting biotech and the pills with better technology to make more precise diagnostic and make more precise therapeutics. I think that's a fantastic hope for others and encouragement for our listeners to go and see, maybe getting into private equity and growth capital, because we need them.
Yeah, love it. Well said.
Well, Meg, what a great conversation today. Thank you so much for coming on the pod. I am really excited about all the market activity that I'm expecting, probably in later stage companies, but I'm going to keep an eye out for the deals that you do. We'll be watching out for all different stages and ages of deals that you do so we can track how things are moving. So really appreciate you coming on.
Meg is just honestly one of my absolute favorites to bring on for any of these topics related to just the finance side of healthcare, because of what she said, which is just that, for a long time, people didn't take her seriously because she had this clinical background and she was an operator. But, my years in investment really taught me that those people tend to be the best at doing the job of figuring out what to invest in. And it really exposes that when you speak with people like her, is that she's got the right perspective, and yet somehow in these circles, she could be taken more seriously than she is.
I thought her comment was spot on. Capital markets are challenging right now, higher interest rates, tighter credit scores, and it's impacting deal flow, even though the deals are there. So I liked her tidbit by basically saying, healthcare sector has generally been pretty resilient, and it does still attract investment firms. But I think we have to be a lot more focused and strategic, and they're going to be looking at high value opportunities that actually have revenue versus just showing the promise of an ARR. I thought that was a great comment.
Yeah, I couldn't agree more. I think as she talked about, really for companies to focus on revenues. And I do find it interesting that she also focused on, in herself and her investment, is focusing on growth and PE capital, which is kind of quite different than what we talk about here a lot. We usually speak to entrepreneurs that are starting up companies, and there's a lot of promise and a lot of excitement. But at some point, I think it's very important to understand what investors like Meg really are looking for. And a lot of the times, just like in biotech and health tech, there's also a valley of death, in that you start out either great product or great service, and you're starting to pick up, you make it and you're picking it up, but then there is a really long lag, and you have to figure out how do you survive in order to get through that lag to be of interest to growth investors, let alone PE investors. Chrissy, on your point, I love the fact that she talked about the various backgrounds of people that can get into PE and into growth. I think PE has traditionally been, just as Meg has said, only a place where you have people with finance backgrounds that used to be bankers. And the fact that there is an opportunity, and people that may do better in PE and in growth are those that have differentiated backgrounds, that recognize patterns, that have training in something other than just finance, because finance, very similar to AI, is sort of a bit of a commodity. It's something that is a tool that you have to use if you're in business every day. And it is something that can be outsourced, but really honing down on what is the technology that's going to make a difference and is going to be eventually bought, used by patients, used by providers and payers. That understanding and recognize patterns and the need is something that is very welcome. And I can see why she has been so successful. Thanks for tuning in to Second Opinion. Share it with colleagues and friends and message us to let us know what topics you want to discuss on the podcast. If you want to support the show, the best ways are to leave a review wherever you're listening and make sure you are subscribed. And check out Christina's Second Opinion newsletter on Beehive. A link to subscribe is in the episode description. Second Opinion is part of Turpentine, the podcast network behind Turpentine VC, Age of Miracles, and more shows for experts by experts in tech.